Hey, this is Chip Brackley with Thrive 34. With all the volatility in the market the last few weeks, I want to put out a quick video about shutting out the noise and making smart investment decisions. As investors, many of us are hyper-focused on returns, especially over the short term. What we've learned over the years is that this type of focus tends to leave us feeling anxious and nervous and less than satisfied with our returns over the long term. Let me give you an example of how short-term investing bias plays out in real life. From 1977 to 1990, legendary investor Peter Lynch ran the Fidelity Magellan Mutual Fund. And over that time period, he returned an astounding 29% per year. That's unbelievable. That means essentially you're doubling your money every 3 years. But when Fidelity decided to do a study to see how investors in the fund actually fared, the results were unbelievable. The average investor actually lost money in that fund over the same time period. So, how do we not let this happen? How do you try and get solid returns and not make emotional investment decisions? The first thing you need to get right is your allocation. You should strive to build an all-weather portfolio, which is basically a diversified portfolio that works well in various types of environments. This portfolio should be based off of several things, but let me mention 3 things that we think are ultra important. First, your risk tolerance. How much you can stomach your account going up and down. Second, your goals. What are you trying to achieve, and do your investments line up with these goals? And then third, you need to take into account all of your assets. Don't just think about your stocks and bonds. Do you have shares in company stock, ownership in a small business, or maybe private equity investments that are all less flexible but have considerable impact on your overall net worth? Those are 3 things that you really need to key in on. First, your risk tolerance. Second, your goals. And third, your overall assets. So here's the bottom line. Here's what you need to do. Most important, have a plan. Always have a plan. Then, build a simple, low-cost, and diversified mix of investments that lines up with your risk tolerance and your goals. The simpler your plan and the simpler your investment process, the better off you are. Doing this will bring confidence in and move emotions out. Don't make decisions based on your feelings about the market. That's how to be a smart investor. I'm Chip Brackley with Thrive 34. Thanks for watching.